if you look at an investment statement, if you're an investor, you've got a financial planner and they've got a portfolio which is 4 different unit trusts from 4 different unit trust companies, each of them in a balanced unit trust. I'm going to use your phrase there. That's diversification, because in South Africa, there are not enough shares listed on the stock exchange that are big enough for fund managers to buy, where if you buy fund manager A, and they've got a portion of the top 40 shares in their portfolio, and you've got B, C, and D, the likelihood is you've replicated the index across those 4 fund managers. And what you've done is you've replicated the index at probably 2 or 3 or 4 times the price of an index. And especially if your financial planner's allocated 25% to each of those, what have they done? They've probably looked at the top 4 performers for the last year or 5 or 10, and they've said, I'm giving you those. Or they've looked at the most well-known brands. You feel comfortable because they're names that you see and you feel like you know. And so that's how your portfolio starts. And then you're very surprised when in 5 or 10 years' time, your portfolio hasn't done particularly well, and you could have just bought one and achieved a lot better returns. So I just think understand South Africa is a very small investment market, and diversification in South Africa is one fund manager plus one index, for example, is I think plenty.